Hi guys, what's up? Ron Parks here and welcome back to my channel. I want to talk today about value investing. Value investing is an investment strategy that involves picking stocks that appear to be trading for less than their intrinsic or book value. Investors believe the market overreacts to good and bad news, resulting in stock price movements that do not correspond to a company's long-term fundamentals. And one of the most famous value investors is Warren Buffett. We have all watched famous investors like Buffett to see if we can figure out, well, how do they do what they do? And once you hear their story or read their philosophy, it all sounds easy, but it is actually monumentally difficult, especially when you're investing in individual stocks. So a little background on Warren. Legend has it that when Warren was young, he said he would be a millionaire at 30, and if not, he was going to jump off the tallest building in Omaha. Well, he didn't need to do that, because in early 1962, Buffett plowed almost all of his net worth, $450,000 at the time, into his investment partnership. That proved a smart move as the partnership had grown to $17 million in value by 1964, just 2 years later, of which his stake was worth $1.8 million. Adjusted for inflation, that $1.8 million share in 1964 was equal to $14.9 million in today's dollars. Eventually, Warren closed his investment fund to new investors and purchased Berkshire Hathaway, which he used and is continuing using as a holding vehicle for all of his future investments. So the Buffett strategy is a long-term value investing approach passed down from Benjamin Graham's School of Value. Warren studied under Graham when Graham was a professor and Warren a student at Columbia University. Benjamin Graham taught the long-term value investing strategy of purchasing stocks at a price below their intrinsic value, then holding them until their price reflected the real value of the company. Buffett described Graham's Intelligent Investor book as by far the best book on investing ever written. In The Intelligent Investor, Graham used a parable of Mr. Market to demonstrate how an intelligent investor should exploit the inefficient pricing of securities. This is the foundation of Buffett's strategy of long-term value investing, and he is considered one of the greatest investors of all time. His investing strategy, value, and principles can be used to help investors make good investment decisions. Buffett became a legend among investors both because of his success and because of the seeming simplicity of his philosophy. The world of Wall Street is incredibly complex and complicated, but Buffett has earned his reputation by making investing seem easy. I was lucky enough to attend a number of Berkshire Hathaway annual meetings in Omaha, where 35,000 people would descend on the convention center to hear Warren and his partner Charlie Munger talk about the companies they invest in, where they see their company going, and opening up the floor to questions for 5 or 6 hours. Warren still lives in the same house in Omaha that he paid $76,000 for and does not live an extravagant lifestyle. So he knows that keeping life minimal has been some of the ways he can use his money and time for more and bigger investments. So I don't consider Buffett to be an investor. He's an owner. An investor is someone that puts $100 a month into a mutual fund, or a salesman who takes his $2,500 bonus and buys Apple stock instead of going on vacation. An investor is an accountant who has 5% taken out of her paycheck to invest in her company's 401k plans. This is not what Buffett does. He buys enough stock to have himself placed on the boards of companies. And even in the beginning, when he just started out, when he was not even a millionaire, the investment partnership he ran bought a company called Sanborn Map Company, where he was made a board member. And when you're a board member of any company, you can guide the company's direction and the hiring or replacing of CEOs and CFOs. But this is not what you and I can do. You and I will not end up on the board of a publicly traded company by investing $100, $500, $1,000, $100,000. So this point is important for two reasons. First, it takes some of the glow and allure away from what Buffett does. He doesn't just find an undervalued company, buy it, and sit back in Omaha to count the money he makes. Yes, he is meticulous about the companies he buys. However, early in his career, he got into the trenches, so to speak, and had an active hand in what many companies he invested in were doing. Second, it emphasizes the fact that if you want wealth, you must be an owner. It's true that you can save and invest a little over the long haul, and if we do not have a market crash like 1987, late 2000, or 2008, then you might end up with a couple of $1 million at the age of 65. But if you want that cash a bit sooner, then the best way is to own or be involved in ownership of a business. Remember, you don't have to be on the board, but it's a mindset, a philosophy, that you're not an investor in that company, you're an owner of that company. So if you're just starting out as a new investor or have a portfolio that you have been growing over the years, you can still use Buffett's advice. It's highly improbable that anyone nowadays can duplicate what Warren has done in the past 75 years. But you can take away some great advice and a roadmap on how to invest like him. So before you commit your money, you need to answer the following question. What kind of investor are you? Some investors want to take an active hand in managing their money's growth, and some prefer to set it and forget it. The type of investor you really are matters. And if you don't have the willingness to stay unemotional when the market goes down and gyrates, individual stock ownership can make your life crazy. If that is you, it is better to start out with mutual funds and exchange-traded funds that are inherently diversified and are managed by people where investing and allocation of capital is a full-time job. Warren is noted for introducing the value investing philosophy to the masses, advocating investing in companies that show robust earnings and long-term growth potential. To granularly drill down in his analysis, Buffett has identified several core tenets in the categories of business, management, financial measures, and value. I had the opportunity to meet Warren over the years, and I can tell you from my firsthand experience that if you were invited into his home, you would see financial reports, SEC 10Ks, and other financial data strewn over the floor of his den. It always looks easy when you see the results of a success like Buffett. But what you don't see is the thousands of hours of research and researching companies to find his value criteria. I'd like to try to summarize Buffett's strategies, which anyone can try and follow. Number one, stick with long-term value investing strategies. Don't let fear and greed change your investing criteria and value. Avoid being overwhelmed by outside forces that affect your emotions. And never sell into a panic. And number two, invest in what you understand. Buffett only invests in companies he understands and believes have stable or predictable products for the next 10 to 15 years. This is why he has typically avoided technology companies. Well, until recently when he owns a really large share worth $73 billion in Apple stock. Number three, invest like you're buying the entire company. I always take a hard look at enterprise value because this is the total price of a company. In other words, it is the price you would be paying for the company if you can buy the whole company at the current price today. And buy into companies with competitive advantages. Companies with pricing power, strategic assets, powerful brands, or other competitive advantages have the ability to outperform in good and challenging times. A long-term investing strategy requires investing in companies that can weather both good and bad economic times. Find quality companies. Buffett believes in quality investing. He would rather pay a fair price for a great company than a low price for a mediocre one. He also believes to keep money on hand. Investment opportunities become available through broad market corrections or individual stocks that become bargains. These are not predictable events, so if you have the cash on hand, you can deploy it immediately, and it's an important concept in value investing. Also, require a margin of safety. Purchasing stocks with a margin of safety below their intrinsic value reduces the risk and provides an allowance for unforeseen negative events. And I would say the biggest takeaway from Warren is compounding and patience. Buffett believes in long-term value investing because he understands the power of exponential growth. Companies with sustainable profits can pay and grow their dividends. There are few more powerful long-term investing strategies than dividend growth compounding. If you're going to do some individual stock investing, then buy companies, not stocks. Work to identify the companies with competitive moats. Ignore day-to-day market movements. Be careful when others are greedy. Control your emotions and invest in what you know. And you can also buy Buffett stock by investing in Berkshire Hathaway, which in actuality is more of a mutual fund because it has a diversified portfolio. In terms of diversification, the greatest amount of difficulty in doing this will come from investments in stocks. As I mentioned earlier, the cost of investing in a large number of stocks could be detrimental to the portfolio. So with a $1,000 deposit, it is nearly impossible to have a well-diversified one. So be aware that you may need to invest in just one or two companies at the most to begin with. This will increase your risk, but your money will be deployed better. And this is where the major benefit of mutual funds or exchange-traded funds come into focus. Both of these types of securities tend to have a large number of stocks and other investments within the fund, which inherently makes them more diversified than a single stock. So again, if you're not in the mindset of doing individual stocks, these mutual funds and index funds are great alternatives. Buffett has been quoted so often over the years that I want to summarize some of the key quotes that I find brilliant. Rule number 1 is never to lose money. Rule number 2 is never to forget rule number 1. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. A market downturn doesn't bother us. It is an opportunity to increase our ownership of great companies with great management at good prices. And warrant on investing for the long term. You can't produce a baby in a month by getting 9 women pregnant. So to summarize, make a list of the criteria to buy a stock. For example, you can look for stocks within a certain industry and with a specific price to earnings ratio or 6-month moving average. Just remember the stock price should not be the sole criteria. Often a good company will dip in price due to the market or the sector it's in, which could present a good buying opportunity as long as the criteria you establish are being met. Invest in industries and companies familiar to you. Understanding something about the industries or the companies you invest in will make it much easier to stay current on the industry trends and company news. An investing strategy based on hype or following other people's stock tips is a recipe for long-term failure. So if you're interested in a company and you don't know much about it, but hear a lot about it, then research it first. Stay in cash if necessary. If no companies on your list fit your investment criteria, hold your cash, wait for an opportunity. And once you invest, follow the companies on a monthly basis. Don't look at them every day. And Warren strongly believes that when a company no longer matches your reasons for buying, sell the stock. If you determine it needs to be above its 2-year average stock price and it falls beneath it, then you sell it. This is what most Buffett followers miss. He has rules and he diligently follows them. And when a company no longer fits his criteria, he sells. So resist the urge to make excuses, stay in the investment, sell it, get out of it, go on to the next one. I think it's fascinating what Buffett has done over his 75-year career. And a lot of his ideas and quotes and philosophy can be distilled down to tasks that you can do and items that you can think about. So I hope you enjoyed this video. If you did, I really appreciate it if you can smash the like button and subscribe. And until the next time, thanks.